I see the Nasdaq soaring. Holy shit. How is my portfolio reacting towards this? Yeah, it's actually... Oh, holy shit! Have you seen the dollar? Holy shit!
It's down, like I said.
Yeah, what the hell? Have we lost Mudsen, or?
No, I'm here. I was just checking the latest news.
Yes, checking his portfolio. He's up like 10% probably.
Exactly.
Yeah, the only thing I see soaring is in my portfolio is actually Broadcom, Realty, of course, Visa, Murphy USA. I don't like this at all.
Okay, wait. How was the test from the phone? It's better?
Yeah, it's much better. So the sound is terrific, Mudsen. So shall we just start, or do you want to say anything, or do you have any questions before we start?
No, not really. I think you and I talked about like some of the details. Let's just have a good conversation and hit all the topics that we have discussed before, and take some questions and stuff like that. I think it would be great. I'm ready.
Yeah, super. So first of all, we will start the episode in Norwegian just to explain that why we're doing this in English. Is it okay?
Yeah, no problem.
Okay, super.
I'll notify my girlfriend that she needs to speak quieter. Denne podcasten og innholdet skal ikke anses som investeringsråd. Hensikten med podcasten er å bidra med informasjon om finansmarkedene og selskaper. Podcastvertene er selvlærte hobbyinvestorer og ikke finansielle rådgivere. Informasjonen som gis i podcasten utgjør kun våre personlige meninger. Hvis du legger vekt på noe du har hørt her, gjør du det på egen risiko. Verdipapirer som diskuteres i podcasten skal ikke forstås som en anbefaling til å kjøpe, holde eller selge nevnte verdipapir. Podcastvertene kan være direkte eller indirekte eksponert mot verdipapirer som diskuteres.
Hei og velkommen til Stock Up, en podcast om finansmarkedet og aksjer. Vi har en kjempespennende gjest med oss i dag, Mudsen. Han er fra Danmark, kjent småsparer fra aksjeforumet Shareville. Vi har jo kjent Mudsen i et par år, og han har hatt en fantastisk reise innen aksjemarkedet, og har gjort det veldig, veldig bra. Det som er så flott med at vi har en globalisert verden og internett i dag og sånn, er jo for man kan dele kunnskapen på tvers av land og kontinenter, og ikke minst at folk får andre input fra kanskje andre kulturer, kanskje andre mindsets, og får rett og slett andre perspektiv også, som gjør at vi som småinvestorer blir på mange måter bedre, sterkere, flinkere og mer, kall det trygg i finansmarkedet. For vår del, Mudsens del, og ikke minst deres del, har vi bestemt oss for å spille inn denne episoden på engelsk. Så vi kommer til å fortsette episoden på engelsk. Så da starter vi bare med å si welcome, Mudsen. We are really glad to have you on board.
Thank you, guys. Thank you a lot. I have been looking forward to it as well. So I'm glad to be here and speaking to you guys for the next hour or so.
Yeah, Mudsen, it's actually quite nice to have the time to talk with you, because you've become quite popular among the Norwegian retail investors through Nordnet Stock Forum Shareville. It's an absolute pleasure to have you as our guest for today's episode. You've shared your portfolio performance with us, and you have had an amazing year with 35% return year to date and an annual capital gain of 36% the last 5 years, if I'm not mistaken.
Yeah, about 4.5 years.
Yeah, super.
Yeah.
That's amazing. Really great. To get the listeners more acquainted with you, tell us a little about yourself, who you are, what's your profession, and your background. And the mic is yours.
Sure, thank you. So yeah, most of you guys know me as Mudsen from Sherrville. I have actually I started becoming more active on Sherrville because of you, Hanfa. I saw that you were getting a lot of traction, some followers, and a lot of engagement on your posts. So I thought it was good to blend in with the community. So that's why I started becoming more active. But I've had Nordnet and actually been investing for um, my investing period has been split up a little bit. So I'm 35 from Denmark. I used to work in a bank in Nordea about 3 years, but that was I think I left Nordea in 2012. I was working within financial advising, so like private customers. And at that time, I did some investing, but I was quite young, so the capital that I had wasn't as big as it is today. And then when I left Nordea, I started going back to school. I left Nordea to study. I have a master in business management and economics. And because I went back to school, I actually stopped investing because of the money. I was in need of capital for some other stuff, traveling and so on. And then I found myself, in the second half of 2019, I found myself in a place economically in my life where I wanted to step it back up again, and that's when I got back into investing. And this is also the reason why, as I told you, I have only 4.5 years of record in terms of my return. So this is where I got back into investing on a more serious note. And yeah, so I have some experience from investing from way back. Then I had a break for a few years, and then I got back, and now I'm all in, as you say. Yeah. But today I work in a bank still. So I was in Nordea, then I went back to school. After school, I worked 1.5 years within the wind industry, so working with clients like Ørsted, Vestas, Siemens. And then I went back to the financial sector, which is where my passion is. So now I'm back in a bank, but not working with investing. I work within a real estate and finance back office kind of position. So mainly within mortgage solutions and stuff like that. Yeah. So investing is on a private note, like a passion of mine.
So what led you towards investing the first time?
So for me personally, yeah, I don't think I mentioned this, but I have Palestinian roots. I come from a refugee family. Been living in Denmark since I was 5 months old. So I've grown up here. Denmark is my home, but I have roots in Palestine, and because of that, or it's not because of that, but we have had some other things to worry about in my situation in my life, and I don't come from a family with a lot of resources financially. So the beginning of my investment journey was more of an attempt to kind of break that cycle, if you know what I mean. So I was trying to see if I could accomplish something on the investment front. Yeah, it's typical that you see the rich get richer and the more powerful get more powerful, and the little man always struggles. And this is the kind of cycle that I wanted to break. And I did okay at the time, but I wasn't taking it as seriously as I am now. And then as I told you, I decided to take on some different decisions in my life, which kind of made the investment journey for me a little bit more difficult. So I stopped for a while, and now I'm back, as I told you. But the main focus was to get some financial resources that I haven't been provided with when I was younger. Yeah, so the financial flexibility and freedom that comes with financial independence is what has driven me towards investing.
Really interesting background. And yeah, a good motivation is always great to to do well.
Yeah, exactly. So I want to do well to give my children some of the things that I couldn't get, and also help my parents. So it's kind of like that. That is the kind of motivation that I'm looking for. Yeah.
Yeah, that's you only win big when you have something to lose, right? Okay, so could you talk a little about about your investment philosophy?
Yeah, so basically, I'm a long-term investor for sure. I have three portfolios actually. Two of them are on Nordnet. One of them is an investment pension account, where my investment strategy is more flexible. So because of the taxes here in Denmark, I kind of take advantage of that and trade more actively. So I sell if I get a profit that I am satisfied with, and also if I see a better alternative, I can reallocate some capital. So my investment strategy on my pension account is more flexible and more active than my normal account, which is in Saxo, and this is the account, my main account. So there, my investment strategy is 100% long term, so plus 10 years. I only sell if something drastically happens. So if my investment thesis changes, or if some extraordinary opportunity presents itself and I need to reallocate capital. So I'm always looking for the next 10 years. And actually, I think the reason for this is actually quite simple. So I don't know if you guys have seen this, but there are several studies out there showing that more than 90% of active investors, and this is both retail investors but also professional active investors, they lose against a passive index fund over the long term. Um, and this is the main reason why, like, these are some statistics and some studies done by some great companies that I don't want to argue with. So I'm trusting the statistics and trusting the data, the historical data, and we all know the compounding effect that can take place. And this is the one that I'm leaning towards. So the long-term investment plan is, for me personally, and I think for most people, by far the best strategy out there. Because if you look at it in the short term, if you want to play that game, you're actually up against some very powerful players. So first of all, most of us have like a normal 9 to 5 job, so we don't have the time uh, to be aware of the market and pay attention to every single thing that happens out there, as some of the professional investors do. They have access to a lot more data than we have. You're up against algorithms, and by looking at these things, it's kind of a losing battle, the way I see it. So I'm kind of changing the rules a little bit, if you can say it like that. I don't want to play the investment field on their terms. Many of these hedge funds, they have like annual goals they need to achieve. They need to beat their benchmark or be very close to it, and this can mean that they will trade more actively, and they by that definition they lose the long term strategy benefits. Some of them can be long term, but most of them need to be very close to their benchmark or beat it. So if they're behind, they make some decisions to catch up. Yeah, and by, and if I want to play the same game as them, it's kind of difficult for me, as for the reasons that I mentioned. That yeah, I'm already falling behind on the data, on the speed in terms of the algo trading. Yeah, and just by time and knowledge, to be honest. So I'm playing a
Yeah.
different game than most of them are, and this is the long term game that has been proven time and time again is the best in terms of total returns.
Yeah, that's a really great point. Like we're all stuck at work. We can't bother or have time to follow every trend and stuff like that. But okay, so if you go one layer down, in terms of your long-term strategy, what are your criteria, or what do you like to invest in for the long term?
So I am a big believer in the know what you own saying within the stock market. And there is one main reason for that, which is I can actually use a real life example. Maybe Hanfa, you will uh, mark me on this one, but we can take Meta in 2022, which is a perfect example of know what you own for me personally. So if you understand the business in the companies that you are invested in, if you know what you own in terms of the business outlook, how the business works, and also confident in the valuation that you have bought this investment at, then you're also much more likely to stay true to your strategy and not be affected by noise or by like big stock market drawdowns. If something crashes, you will be much more likely to stay true to this strategy if you know what you own and you're comfortable owning it. So this is my main thing, and when I say that, I mean I buy companies, or at least I have some companies where I don't fully understand the product and the investment thesis, but these will always be low conviction stocks for me. So if I go all in on a stock, if I have high conviction in something, I put a lot more money into the stock. But these are only stocks that I understand, where I am very comfortable owning the stock no matter what happens out there. So this is my main thesis: is know what you own. It's really important. At least if you're serious within trying to be an active investor. A lot of people, a lot of retail investors, they just buy, different stocks. We all know a lot of great companies, but we don't, maybe we don't understand them fully. And this actually goes a little bit back to Warren Buffett, who has talked about this a lot before, about knowing what you own. Because if you buy 50 stocks, first of all, you won't have time to keep up with everything in terms of the earnings reports, in terms of the business outlook, in terms of the news coming out. So I prefer to keep like a concentrated portfolio of a maximum 10 stocks, where some of them are high conviction stocks with a lot of weighting in my portfolio. Uh, exactly because that I am very comfortable owning them, because it's an area that I understand. And for me, this is mostly in real estate. So my main portfolio weighting is to be found within real estate.
Okay, that's interesting. Like physical real estate or stocks?
Stocks, yeah. So I think
Right. Okay.
there's a lot of benefits to REITs, which is kind of like a mix between a stock and a real estate, like properties. I prefer the real estate, or sorry, the stock market in general, because of the liquidity that is much more, it's much more liquid than physical real estate. So I'm all in on stocks. I don't own any real estate rental properties. I get my exposure to real estate through REITs.
Okay. What kind of REITs do you like?
So I own 3 REITs actually. One of them is Simon Property Group, which is my biggest position, and it has been so for the past 4 years soon. At the moment, it's currently about 44% of my total portfolio. And then I have just this year taken a big position in realty income as well. And then I have Vici Properties on third place within the REIT sector. But these 3 stocks make up about 65% of my total portfolio. So it's probably a little bit more different than what you're used to seeing from retail investors, and kind of goes against the diversification is key thing that we are all very familiar with. But for me, I think this is what works best.
Quite interesting, because we're actually at a very kind of a high leveraged economy, and especially regarding the real estate sector. So don't you see a lot of headwinds actually the next year, even though the Fed or the ECB or the other central banks cuts rates?
I don't actually. I think within, so of course not all real estate is created equal. There's some big players, some great quality players with good management, and good balance sheets, which is very important. And I've also, every time I have written about real estate on Shareville, I've always emphasized the need to tread carefully when it comes to real estate in a higher rate environment that we're seeing today. Because as you say, some companies can find themselves in big trouble because of the higher refinancing rates. But the three REITs that I've chosen are some of the best. Simon Property Group and Realty Income are some of the best with a proven track record, great balance sheets, and good management, which is why I'm very comfortable owning them. But also, it comes down to one of the last things that you just said, that my thesis on the rate environment is to the downside. So I think yields are going down. So I think REITs have some good upside ahead as well. But as I also started out by saying, is that my outlook is plus 10 years. So I really don't care what happens within the next 2 years. For me, the most important thing is that my stock survives. So whatever happens in the economy, if we get a recession or something like that, my stocks or my companies will still be there on the other side of that. This is the most important thing. But what the stock price does within the next 2 years doesn't really matter that much to me at this point, actually.
Interesting.
2023 has been a great year for evaluations then for you to pick up some cheap stocks.
Exactly, and this is actually what I've done the past 4.5 years. So as I told you guys, I started investing again in 2019, and I had about these 8-10 stocks going into 2020, and then COVID happened. And I'm a big believer in having high convictions, but also when you have these high convictions, you put money behind them. So not only you think of a stock is going to be great, but also that you have the courage to take some big bets on them. And this is also very atypical. But actually, in 2020, when I went into 2020, I had, as I told you, 8 to 10 stocks. Then COVID happened, and I saw some of the greatest companies out there just simply crash. And Simon Property Group was one of these. In the beginning, I think it was in March or April, I started to nibble a little bit. So I bought some shares of Simon Property Group and sold and bought and sold again because of the volatility. So I was making like quick 10-15% gains within a few weeks, and then it would crash again because, as you remember, every article that came out there or news about a new wave of COVID and all of these things, the volatility was just crazy at that time. But as a long-term investor, volatility is your friend. You have to be very happy that the market is volatile, because that is where the biggest opportunities comes in. And this is what happened to me in 2020. I actually we saw in 2020 about, I think it was in June, we saw some sentiment out there in terms of reopenings. And I actually saw Simon Property Group go from 60, 65 share price up towards 90. And at that point, I was out of it. But also when I was trading it before, it was small positions. But at that point, I was out of it. And then we heard the first news of a second COVID wave, and the stock crashed back towards 60 or something like that. And I was very happy with that, because that was my cue to go all in. So I had just witnessed firsthand how a reopening would impact the stock price. I saw it flying from 60 to 90 in a matter of weeks. And then it crashed again, luckily for me. So what I did was, actually, I sold my stocks, all of them. So I sold all 8 or 10 stocks that I had at that time, and I went all in on Simon. I think my portfolio weighting in Simon Property Group at that time was about 95%. And I was just accumulating, actually, for about 5 months until November 2020, when I think actually it was Johnson & Johnson who came out with the first COVID vaccine results that were good. And that sent the stock 30% up in one day.
Wow.
And so I as I told you, it was a high conviction stock for me, and I put the money behind it to support my thesis, and I'm very happy for it today, because it has created the base and foundation for my overall returns, because of my very low cost average on the stock. But all new capital that was coming in from after that point, so I haven't bought it afterwards. So all new capital have been going towards other stocks, which is why the stock now is only 44% in weighting. But yeah, I went all in for sure.
Wow, that's very very cool, very interesting. So, talking about real estate companies, especially REITs, then the balance sheet is of course very important, and the debt, the capital and debt structure. Well, how do you when you look at the REIT, what do you look for? What you like to see and what you not like to see?
Yeah, so one of the very important things for REITs or metrics is interest coverage and debt to EBITDA, which is the financial metric that most REITs use to explain how strong they are in terms of their debt position. So how well can they manage the debt? And these are the two main metrics that I use to look at. But this doesn't go only for REITs, but for all stocks. Free cash flow is the most important thing for me when I look at a balance sheet, regardless of what stock it is or what sector it is in. And the same goes for REITs. So REITs are very capital intensive businesses. You have some high capex on many of the REITs because they need to be redeveloped and maintained. But what is left is the free cash flow after the operational. The cash from operations, you minus that, take the cash from operations minus the capex, you're left with the free cash flow, and this is even more important for REITs, especially because of the, on average, higher debt loads than you see on some other stocks. But I also look at the credit ratings, which is very important. I have talked about it a little bit on Shareville at one point. When it comes to REITs, because it is so capital intensive, access to cash and access to capital is very, very important. And the higher the credit rating is, the better deals you can get on your capital. And also, with the better deals on the capital, your cost of capital goes down and your investments spreads go up. So if you have a REIT and if you're a REIT and you buy a new property, the cap rate is what is generated in income on this investment that they make, and you subtract the cost of capital from that, and you're left with the investment spread, which is in the end what goes back to you as a shareholder. So this is the shareholder value that is created. It comes from that spread. So the better the credit rating, the better the lower the cost of capital, and the better the spread they can make for you as a shareholder. So I look at credit ratings, I look at the interest coverage, and I look at the debt to EBITDA as the three main things when I look and evaluate a REIT's balance sheet.
But Mudsen, it's brought to my attention that you sold Alphabet, also known as Google, to actually increase your amount of shares in Realty. May I ask why? Because in our last episode with Arne, he was like, yeah, Google is kind of cheap today, and given their perfect balance sheet, if you compare it to the real estate sector with no debt. So why are you kind of chasing stuff that can't grow as much as Google, for instance?
It is true that it won't grow as much as Google or any of the other stocks, but this has also been priced into the stock. So the valuation is reflecting this. And for me, it's all about total returns. And the total returns are made up from your starting point. So if you buy, let's say, Palo Alto, for example, at a very, very high multiple, it may be a great company and a great stock, but because of the higher multiple, all else being equal, you can expect a lower total return on the long term because at one point the earnings need to catch up with the multiple. So you will have a period of multiple compression. And what I see here with REITs and with realty income, at that specific example, actually I timed it pretty well. I bought it. I don't know if you remember it, but when they announced the deal of they were going to acquire Spirit Realty Capital, the stock crashed the day after, and it went down to 45. And this is where I saw like my capitulation moment from the market, and I took the opportunities. I reallocated my capital. I sold Google, and bought realty income, or bought more of realty income at 45.8 or something like that. And already from the next day, it was going up again. But I didn't buy just because the stock went down. I bought because I saw the news and I read the investor presentation of the acquisition that they were going to make, and I thought it was a clear overreaction from the market. So the deal is about to make realty income the fourth biggest REIT in the S&P 500, and the deal was accretive to shareholders, meaning the FFO per share was going to grow by 2.5% by this deal. And I think the stock market overreacted quite significantly, actually, because the deal is going to be made in an all stock, so they're going to pay for the company with stocks. And most people were saying that it is dilution, like they're diluting you as a shareholder, but it's not dilution if they issue more shares, as long as the FFO per share is increasing. So as long as the value that is gained from this acquisition is bigger than the cost of new shares, it is accretive to you as a shareholder. And it was that at that point. I read the investor presentation. They acquired the company and took over the very low debt at a low rate from the company that they already had in place. And the deal was because of realty income's higher trading multiple. So in the market, realty income was trading at a higher multiple than Spirit Realty, and this is what made the deal accretive for shareholders. 2.5% FFO growth over the next year immediately. Yeah. So starting from day one.
Look, Mudsen, realty is my only real estate exposure in the financial markets. And Direk, or Kenneth, he also loves realty, as our listeners know. But you have to admit that it's kind of strange for a company like realty, which has tenants like Walmart, Dollar General, Lowe's, and so on, to acquire a company which kind of doesn't represent the quality tenants like realty is used to have. So I get the negative sentiment, if you know what I mean.
But have you looked at the portfolio of the company that is being acquired by Spirit? Actually, what it is doing for realty income and for you as a shareholder, it is diversifying the realty income real estate portfolio. So before it still has a very big retail exposure, but this percentage is decreasing, and they're gaining traction in some other sectors that they didn't have that much before. So, for example, industrials. Spirit Realty has more industrial properties than realty income does. So realty income's exposure towards that sector is increasing with the new deal. And their exposure towards retail, for example, Dollar General, Walgreens, all of these companies that realty income has about, or had about 11% of before, of their total portfolio, is decreasing now to, I think it was 10.1% or something like that. So the acquisition of Spirit Realty is actually just diversifying realty income's real estate portfolio, which I think is good at this point, because their real estate portfolio they have a lot of properties, but it is very retail focused, which is more cyclical. Obviously, some of them are in businesses that are not as cyclical and not as how can you say, like more, they're not as sensitive towards the economic cycle, but still the retail has some cyclicality to it because it is exposed towards the consumers. So if the consumer is suffering, in the end it will hit realty income's tenants, and in the end realty income. And this exposure towards retail is decreasing with the new deal. And so yeah, I get your point. And my main concern with realty income is that it is becoming very big, and they have about 13,000 properties at the moment. So they need to make a lot of deals in order to grow going forward. Like it needs billions. I think their annual estimate for this year was about 9 billion in investments towards new properties, just to grow these 3-4% that they are growing their AFFO with. So at one point they will meet some kind of wall, you can say that, in terms of new investment properties that they can acquire. So at one point, I think this is what we're seeing now. They're going in other directions. So instead of buying the assets directly, they're buying REITs at this moment, and they also started to go towards more like experiential real estate, for example, casinos, like B2 properties. So they're kind of expanding their normal field of investing and diversifying that way. And some people think of that as a negative because it's out of their uh, field of expertise. And some people are happy with it because it gives them some diversification and new growth prospects.
Yeah.
And I'm kind of mixed on that one.
They're quite good operators, and with their low cost of capital, if anyone could do it, I think they could do it. And yeah, they're A minus credit rating now, so
Yeah, exactly. And as I mentioned in the beginning when you asked me the question, for me, it's a matter of valuation and upside going forward. So I know that growth is only going to be 4%. This is what it has been the past many years, and I think this is the level of growth we can expect going forward as well. But it's coming from a very low level, low multiple, which should give some very good upside for you as a shareholder if you're new to the stock, if you're buying it today. So this is my thesis. So I'm locking in yeah, at that point it was 6.7% dividend yield when I bought it, when it crashed to 45, 46, which I don't have any expectations of them cutting at any point. They have a great track record. They increased the dividend through the dot-com bubble, the financial crisis in 2008, and also the pandemic. So yeah, it's going to be very, very bad if they would ever need to cut the dividend. And at that point, I think we, as a human race, will have bigger problems than that. So I think they have proven themselves over some very big crises in the past, and this is why I think it was a great deal for me. So I'm locking in this 6.7 yield at that time, plus some multiple expansion when rates go down. Overall, that should give me a 10 to 15% return over the long term from that cost basis, is my calculations.
Sounds like a good risk reward. So before we leave real estate, I'm just curious with respect to the interest rate coverage and the debt to EBITDA. Do you have some ratio numbers that you like to look at? What is good, what is bad?
Yeah. So for me, when it comes to net to EBITDA, it's between 3 and 4, which is what I find acceptable, or not acceptable, but comfortable with. If it's above that, then I would like to see some kind of plan from the management side to get below it. And I think most of the good REITs out there are in that range. 3, some can go above 4, but between the 3 and 5% range. And when it comes to interest rate coverage, anything above 4 is very acceptable for me, but 5 is preferable. But with higher rates across the board now, that is the single biggest line item on the balance sheet of REITs that will affect the FFO or the earnings in general. So it's very obvious and very understandable that when rates go up, some REITs will have a problem or a difficulty growing their FFO. But at the same time, when rates go down, you'll see it go the other way. And we can talk a little bit about macro environment and the Fed later on. I think we have that in the program, but I'm pretty sure that rates are going down dramatically in 2024. So this is contributing to supporting the investment thesis that I've made for REITs at the moment. And in general, I think REITs, the best of them, will have a great upside going into 2024 because of the tailwind from the macro.
Yeah.
Yeah.
Yeah, sounds good. So do you have any other companies and sectors that you like to invest in?
So REITs are about 65% of my portfolio at the moment. I have another 25% in 2 stocks in tech. One of them is Meta, and the other one is Microsoft. So yeah, these 5 stocks that I have within REITs and tech make up 90% of my portfolio. And I think I have talked to Hanfa a lot about this before. even though he doesn't like tech, I think tech is here to stay. At the moment, I think they are priced quite aggressively, and I'm not a buyer at these levels. Of course, you can find some companies and some stocks that are acceptable and have a decent valuation, but overall, as a sector, I think they have had their run in 2023, and I think 2024 is going to be a lagging year in terms of performance from this sector. But for the long term, I'm very positive on tech and cybersecurity as well. Very, very positive on cybersecurity. But it's a more complex field, and I'm not uh, I'm not an expert on the field in terms of the product and the cycles, and this is also why I will never have a high conviction stock. I can have a high conviction investment thesis on a company. For example, Palo Alto, I think, have a great future ahead of it, but not such a high conviction that I'm willing to put a lot of money into the stock because I don't understand the field aggressively like I do in real estate and some tech areas. It's much more complex. I don't know if you own any cybersecurity stocks, but if you go on a conference call on one of them and try to listen to the things they're talking about in terms of the actual product, you have to be working within that field to understand it. So if you want to know if your company that you have invested in is doing the right things, or if they are being pressured by competitors, you have to have some kind of knowledge about the field and the product. And I don't
Yeah,
have that, so that's why I will never make it a very high conviction bet in my portfolio. It will always be a small position for me.
yeah, exactly. Yeah, that's a very good thing because I also have experienced the same thing. I've been following CrowdStrike and Cloudflare a bit, and it's really difficult to understand
It
everything
is
what they're
very
talking
difficult,
about.
and yeah, exactly. It's very difficult, and because of that, I trust the numbers, which is why I invested in Palo Alto and Fortinet to begin with. You know, from the balance sheet, of the income statement, cash flow statement. So I like the numbers, I like the growth prospects, but I don't have a deeper understanding of the sector in general. And I think especially as a retail investor, you really need to be honest with yourself about your capabilities and. Uh, yeah, the possibility of you being right on a trade like that. And I'm not so sure that I am right on a trade like that, which is why I don't put a lot of money into it. So 2% is my target, percent of total portfolio. Yeah.
Do there's no uh, you can't compare REITs to some other ordinary stocks, if I may call them ordinary, because their balance sheets are kind of accounted for differently. When you
Yeah.
look at other companies besides REITs, for instance, tech companies, industrials, uh, uh, what what are you looking for in the balance sheet? Because that was kind of the most popular uh, poll answer from our listeners to get your idea of what are you looking for. Is it margins? Is it kind of the debt level, the capital structure, high ROEC? What do you look for?
Yeah, so actually, you can compare REITs to other sectors. It's just that the earnings that you normally talk about with normal stocks is different with REITs because they own real estate. A lot of their assets are from real estate, and in terms of the U.S. GAAP accounting rules, real estate needs to be accounted for. So depreciation will be big when it comes to REITs, and this is why their net income will be very low compared to other stocks because they have a lot of depreciation from these real estate that properties that they own. But everything else in the on the balance sheet, cash flow statement, income statement, and balance sheet, all of it can be measured, can be compared. Obviously, you have to compare REITs to other REITs to have a sense of how they're doing compared to their peers. But free cash flow is the same, capital structure, assets, liabilities, it's all the same. So I would just wanted to make that clear from my point of view. So you look at FFO because that adds back the depreciation for REITs, which is a very a good thing for REITs, and it is the most um, the most valid way to assess and evaluate the multiple and valuation of a REIT. But in general, when I look at the income statement, or in general, when I look at the financial foundation from companies, so obviously you have the income statement, balance sheet, and cash flow statement, and I look at some of them. I look at some specific things on these statements. When I do my initial screening of a stock, so every time I take in a new stock on my radar, or if I hear about a new stock, for example, when you told me about Dollarama, I did like an initial screening on it. I look at some specific things. I want to see revenue steadily increasing, because I think EPS growth in the future mainly needs to come from revenue growth. So you can get EPS growth from buybacks, or if a company cut costs, but when it comes to cost cutting, there's only that much cost cutting you can do. So at one point you will hit the wall, and the extra EPS growth that will come in the future needs to come from revenue growth. So this is my main thing from the income statement, along with margins. I look at growth margins and I look at net income margins for sure. And the margins differ a little bit depending on the sector you are assessing and analyzing. But as we said with REITs, when you compare companies, make sure to compare them to some of the peers to get a better sense of how are they doing in terms of their or in relation to their competitors. But on the income statement, I actually, when I do my initial screening, I only look for increasing revenue and the margins. So this is my basic things to look out for on the income statement. Then
just continue, Mudsen.
Okay. Yeah, and then I jump actually straight to the cash flow statement, which is the most important one for me personally, because I think most of you guys have heard the saying that the value of the stock is based on the future value of the cash flows, and this is why the free cash flow is the most important thing for me. So the free cash flow is what gives a company financial flexibility. They can buy back shares, give you some dividends, pay back debt, do some acquisitions, and reinvest back in themselves. It gives the financial flexibility and power that is needed to navigate in a always changing global world and macro environment. So I have free cash flow on top of my list of things to look out for.
May I ask you a question? I have to jump in here because you're mentioning a lot of stuff, and you bought more realties and REITs and so on. That's nice. But one of your favorite companies, if I'm not mistaken, is McDonald's, right?
Yeah, I like the company. I have a small position in it now. Not a big bet, but yeah, I own it and I like the company.
But why didn't you buy McDonald's, for instance? 30% profit, or actually, 35% profit margins, expanding like hell. Comparable store sales increased like double digits, and it's recession proof. It's not that sensitive to Fed funds rate. It seems to me like every company you look for is actually rate sensitive.
I do own some rate sensitive stocks at the moment. That's true. And the reason why I didn't buy McDonald's and went more all in on realty income, for example, is because of the upside potential that I saw ahead. So I'm very sure that McDonald's will continue to grow, but from that very low cost basis. So REITs in general have crashed for the last year and a half or 2 years. And this has provided some, for me, extraordinary opportunities. So it's very rare for you to see McDonald's crash. And when I invest, I try to, I think actually this is also one of the reasons behind me having a 36% annual return over the past years, is because I have the courage to go all in on some stocks that have been crashing unjustified. So of course they have been impacted by higher rates, but I think it is very, very way overdone. So it's too much in terms of valuation. The valuation is the reason why I bought realty income and not McDonald's. because I think the overall long-term return will be higher from that starting point of realty income than McDonald's was at that point. So it's always like,
Interesting.
yeah, it's always it's a dynamic world, and the stock market is also dynamic. So for me, it's always changing, and sometimes opportunities present themselves, like they did in 2020 with Simon Property Group, and realty income. When I saw that crash to 45 because of the new acquisition, so I try to, if I think the stock is great and the future is looking bright, then I try to seize those opportunities by taking the chance. So I think it all in the end comes back to what do you want as an investor and what is your game plan going forward. So if you just want to sit back and relax and enjoy market returns and maybe even a little bit better than market returns, then yeah, sure, you can buy McDonald's. And I also did it, but I waited for the pullback. But I tried to go a little bit more for the extraordinary, if you can say it like that. I think realty income at 45 was a very, very good opportunity, and I didn't want to miss it. So this is the reason. Yeah, I think as we talked a little bit about in the beginning, when you're a retail investor, you have some odds against you when you're up against some professional people and algorithms and stuff like that. So it's very important that, for me at least, that when we see a great opportunity, that we also manage to seize it. Yeah. So this is the reason why I went all in on some of the crashing stocks in 2022 and 2020, and also with Meta in 2022 and Google as well. Actually, I've sold Google now, but both of them and Microsoft as well. I bought one extra position in Microsoft in 2022, but I loaded the boat, as you say, with Microsoft, with Meta and Google. So I took the opportunity of these crashes that they experienced, and yeah, it paid out very nicely in 2023. Mostly due to AI, that's clear, but yeah, they rebounded significantly, and I enjoyed the benefits of the purchases that I made in 2022 when the whole market was against them. So you can call me a little bit contrarian, if you can say that at some points. I always try to see the opportunities that comes with the volatility in the market, but my thesis is always long term, for sure.
Yeah, that's interesting. Before we take the questions from our listeners, it's just fascinating because you're talking about holding stuff long term. If you bought, for instance, Microsoft last year, why the hell would you sell them now?
I didn't buy Microsoft last year. I bought Google. Yeah, and yeah, the reason for that was because I think Google is. I'm not completely convinced, but I think Google has some. For me, when I sell a stock, it's only because the investment thesis has changed, or if I see an extraordinary opportunity elsewhere. These are the only two reasons why I would ever sell a stock. So when I buy them, I have a clear goal of why I bought them and when I want to sell. And for me, I only sell when one of these two things happen.
Okay, so it's because you saw a much higher upside potential in realty. That's the only reason.
Yeah, it was a mix of the two. So I saw a very good upside potential in realty income, and I also saw a little bit of doubt when it comes to Google. So I agree that on current economics and financial data that we're seeing from Google, so like free cash flow and revenue and EPS and all of those things, Google is looking great. But I'm a little bit more in doubt when it comes to the future of Google, because yeah, you've all heard the story about Microsoft and ChatGPT, and which is why Google actually crashed to 85 or something like that last year, because the market was worried about Google falling behind on AI. And now it has rebounded, but personally, I'm still not sure that they are catching up. I think they are falling behind on some of the things. I think management has been doubtful in some of the things that they have provided the market with in terms of AI, which is a growth catalyst that is priced into the stock. And we're also seeing it within the cloud sector in Google, cloud division in Google, which is also why the stock sold off after the last report, actually, because the growth in cloud was lower than what the market was expecting. So I'm seeing some things that could potentially change the future of Google, and that combined with the better opportunity in realty income was the reason why I sold Google, and also because I have a big exposure towards the advertising market through Meta. So it was kind of like a repositioning, taking some risk off from the cyclicality of the advertising market and seizing the opportunity in realty income, and also because my investment thesis on Google is not it's not crashing, but is a little bit flawed at the moment. So I'm not completely sure of the big moat for the future for the next 10 years that they used to have. So this is the reason.
That was a very nice reflection. So we will this will be kind of our last question regarding the real estate sector, because this is from one of our listeners, BBTRH. He asked if you could answer: are you bull bear towards the Scandinavian real estate sector when you take into consideration today's interest rate level?
Yeah, so I will be honest and say that I don't follow many real estate stocks in Scandinavia. I had a position in Castellum at one point, which was the only time that I did follow it. But in general, so I'm not going to give company specifics, but in general, if you are invested in good REITs or real estate companies in Scandinavia, I would be bullish, yeah, because I think the rates are going down drastically in the euro area in 2024. I think we're already seeing signs of recession in many places in Europe, and it's only going to get worse in 2024, in my view. And these tailwinds from lower rates is going to support the multiple expansion of some of the best in the market, some of the best real estate companies. In Sweden, I would be a little bit more careful, actually, which is also one of the reasons why I sold Castellum at that point. So, yeah, many of you guys know already, they have a lot of floating rate in Sweden. And at the same time, you have the currency, which is at historical low levels, which is kind of supporting the inflation narrative in Sweden. So the Swedish central bank is kind of in a dilemma. Do you want to raise rates to support the currency and make inflation go lower, but potentially damaging and maybe crashing the real estate market? Or do you want to keep a hand on the real estate market, but still deal with inflation and a weak currency? So this is kind of the dilemma that they have at the moment, and I'm not sure how they're going to solve it, actually. And this is why I think the risk reward is tilted a little bit more towards the downside for me in the Swedish real estate market. I think you could make it a small bet if you want to, but only in some of the biggest players there. But I would never make it a big position because of these things.
Yeah, it sounds like you're talking about Norway, actually. We also have a
It's
very
the same in Norway.
leveraged, very leveraged real estate sector, and a lot. That's
Also
almost,
floating rate, variable rate.
yes, a lot, and many of the banks have a lot of exposure to them. So
Yeah, and this is a very big problem actually when you have a very weak currency, because you will see higher inflation, and this is one of the mandates of the central banks. They need to create and keep price stability. So in order to get inflation down, they need to hike rates. And when you have a very rate sensitive sector that is very burdened with floating rates or variable rates, that becomes a problem. And yeah, this is not a problem that I as an investor want to be a part of. So for the moment, I'm staying out of it and leaning towards the American real estate market, which is in better shape the way I see it.
yeah, that's great. And with regards to Castellum, that's a very good example of they don't have control over their net debt to EBITDA. I think at the worst it was like 14 or something. It was crazy
Yeah,
leveraged.
they don't, and you saw they needed to meet their financial requirements, and they did that by starting selling some assets. And they cut the dividend as well.
Yeah.
It's good for the long term of the company and the health of the company, but it kind of destroys shareholder value when they do things that goes the opposite way of what they were projecting to begin with. So when I invested in Castellum, it was on a investment thesis that kind of quickly turned out to be not true, because they had projected some things that just weren't compatible with the reality of the new rates. So they quickly turned to the bank to get more capital, and they sold off some of their assets to get more capital. And this is exactly why you need to be invested in the best of the best when it comes to real estate, because access to capital is just crucial.
Yeah, it's really
especially in this
important. I
market.
think we'll move further so Faruk doesn't get a syntax error again. But if you'd like to have exposure to the Scandinavian real estate market, that I think your best bet is to find a diversified fund that has a focus on the financial stability and a good balance sheet. That's your best. If you take
Yeah.
a single company risk, then you could get flat-footed and
Yeah, I agree 100%. And this actually goes back a little bit to what we talked about in the beginning, that you have to be honest with yourself. And most retail investors in the long run can't beat the market. So especially when it comes to sectors that you maybe don't understand, or where you see a high risk, but you still want exposure towards it, then there's nothing wrong with getting exposure through an ETF or index fund. I think
Yeah.
that's a very good strategy for most people, actually.
Yeah, I agree. Okay, so we have some more questions from our listeners from Discord, and this is from Elmetrus. What's your main target with investing? Is it to beat the world index?
No, actually, it is financial flexibility and freedom, as we talked about in the beginning. So it's kind of inspired by the FIRE movement. Maybe you guys know it. It's kind of in the same alley, but it's not exactly because I want to retire early. It's just because I want the financial freedom to be able to retire early if I want to, or to be able to do some things for my family and friends, and actually also charity work. So just in general, to have some financial muscle that I can flex at times. So for me personally, I have a nominal goal, so an specific amount that I want to reach within before I turn 50, and this is the amount that will determine whether or not I was successful in my investing. Obviously, along the way, I will evaluate. I always do that. I have a very detailed statistics on my performance every year, and I compare that to my benchmarks, because in the end, if you're constantly underperforming your benchmark, then again it goes back to being honest with yourself. Maybe you should just invest in index funds. I get the point that most people love stocks and investing, and it's much more interesting and more fun to invest in single stocks. I also feel the same way, but for me personally, in the end, it also comes down to actual money, like actual returns. And if I can see that I'm underperforming my benchmark 2, 3, 4 years in a row, then maybe it's time to reevaluate and reassess my strategy, and maybe go more towards the proven, which is passive index fund.
Yeah, this is a great advice for everyone out there, because as an investor, you need to make your business plan and have a goal, and formulate your strategy, and then execute, and then, as you say, compare against your results against your strategy.
I really think it's important, because so in the end, when you begin investing, you need to have a very clear strategy. Why are you investing, and what are your goals with investing? And goals need to be accounted for. So along the way, you need to measure how are you doing in terms of the goals that you have set up for yourself, and could you have done it otherwise in a way that would have given you a better result. So it's a constant evaluation and assessment of my own performance, that I would also advise everyone else to take a look at. You can do a lot of things by investing in stocks, some good blue chip companies, keeping them for the long run without paying too much attention. But if you do that, you also kind of say that you're happy with average returns, or you don't really care what kind of returns you're getting. So I have specific goals, and I have clear guidelines on how I want to be measuring these goals, in terms of which benchmark am I using, and how many years can I underperform before I need to reassess my strategy. And so far it's been going very good, so I'm just gonna keep on doing it. But I think strategy is also a thing that is constantly changing. So for me personally, I had a strategy. I still have it actually, but I will transition to another strategy soon enough, I think, for the first million. So when you're beginning your investment journey, I think most people should have a strategy that will change going forward. Meaning, when you reach a certain point of, for example, dollar amount or a specific amount that you want, your strategy needs to change in terms of your risk profile. So instead of hunting for gains or for returns, I would go more towards a strategy, maybe a little bit more similar like the one Hanfar has, which is more capital preservation. Of course, returns is an important thing, important part of his strategy, but his main point is to protect the downside. And I think everybody will need to make that transition at some point in their investment journey when they reach a certain amount, because the risk profile kind of changes. So for me now, at the moment, I'm all up for taking some risks, but only in big companies. And I will transition a little bit more towards the defensive sector as we go along, because I have reached that milestone that we just talked about.
Yeah, that sounds great. It's an echo of what Arne said on the last episode, that as you grow and your knowledge compounds, your strategy and your experience evolves, and then your knowledge as well, and then you can take great decisions.
Exactly. It's a journey where it's a process and a journey, and you learn along the way a lot of things about yourself, a lot of things about your strategy, but also the markets. And as time goes by, you will be able to use these things to your advantage. As you guys know, emotions are a big part of investing, and people who are in control of their emotions, I think, will do better in the long run. And being in control of your emotions is something that comes from having experience. Having experienced a big crash, how did you react? What could you have done differently? Stuff like that. So yeah.
Yeah, sounds great. So, and we had another question from Ripper X7. This is a company-specific one. Why did you choose Fortinet instead of Arista Networks?
Yeah, actually, I saw this question from him, and at the point where I bought Fortinet and Palo Alto, I bought them at the same time. I actually didn't know Arista Networks, but I have recently become acquainted with it, and what I have seen so far, I've only done like an initial screening on it. It seems like a very, very good company with a good future ahead of it. So there's no reason why I didn't go for that. I didn't know about it at that time, so this is the main reason. But if I had known about it, it would definitely be in the mix there between those three. But my main reason for buying Fortinet and Palo Alto is because of their track record and their position in the cybersecurity field. So as I told you guys, my experience and knowledge about the cybersecurity is as a product and a sector in general is at a very how can you say, like a high level from a helicopter view. I don't know much about it in details. So I went with the ones with proven track records, great financials, and I trusted the management. So I just went with the flow, if you can say it like that.
Yeah, I understand. Yeah, I think that the known tech guy Tony Lee, he was on Compound and Friends for a couple episodes ago, and he talked about Arista Networks and was really bullish on it. So I don't remember which episode number it was, but a few episodes ago, it was very interesting to hear. It was one of his high conviction ones
Yeah,
for
I agree,
2024 and beyond.
and I actually put it on my watch list, and I will keep an eye out on it in the time to come, because it is a very exciting company. And I actually compared, yeah, I think it was yesterday. I compared the valuation to some of the others in the sector. I think it's looking pretty compelling at the moment. So
It's interesting.
yeah.
Okay, so next question was from Woodson. What kind of mistakes have you done so far as a retail investor?
I think my main mistakes have been some of the things that most people have done as well. So in the beginning, when you begin your investing journey, a lot of people struggle to find their strategy. They may be buying stuff that they don't know a lot about, or they bought stuff because someone else told them it was a good stock. They bought stuff without making some calculations on it. all of these things that you should be making, these decisions and thoughts that you should be having before investing, when you're beginning, it's just not these things that are taking up a lot of your investment analysis. So it's more about being in the market and feeling your way out there. And these are my main errors or faults. So when I began investing, I used to buy stocks because I heard it from a friend, and I didn't really know what I was owning. And this also comes back to what we talked about before, where when shit gets real, when the stock market crashes, if I don't know what it is that I'm holding, yeah, most likely I will panic sell at the bottom. Yeah, but now I have turned that thought to a more fundamental view. So, for example, with Meta, the stock was crashing, but what I could see from the reports was that the fundamentals were doing very good. All of the key metrics in Meta were improving. Daily active users were improving. Cash flow was improving. All of these things were improving. So yeah, now I have more a fundamental view on things. My should I hold or should I buy case on the fundamentals instead of the stock price. But in the beginning, it was much more emotional for sure, and I think it comes with time that you can learn to control it. But I think people should be very aware of the fact that nothing goes up forever and nothing goes down forever. I think these are things that I've learned the hard way, and I'm very aware of at the moment. And when I say that stocks don't go up forever, is because I sometimes see a tendency in retail investing where you buy something that is experiencing some big hype at the moment. For example, Nvidia, when it was just rallying and multiples didn't matter, everybody wanted a piece of Nvidia. This is not my investment strategy, but I did do it in the beginning, and I think this is what I have learned the hard way, that it can be dangerous when things turn, and they will eventually, because, as I said, nothing goes straight up or straight down. So buying at a top due to hype is a common thing that I think most people have done, and I think it's something people should be aware of.
Yeah, it's a very I can relate.
Yeah, we've all done that.
Yeah. Okay, so next question were from Tina too, and okay, I think you have already answered this, but what stock have contributed most to your amazing return? Was that the Simon Property Group or?
It is Simon Property Group, yeah. In my Saxo account, it is definitely Simon Property Group because I went all in on it in 2020 and my cost basis is so low. So I put almost my entire portfolio in it at the stock price of 65 at the moment, or at the time. And today is trading at around 135. So my yield on cost, the dividend that is paid today, based on my average on the stock, is about 10 or 11%. So you can see the dividend alone is more than the average historical market return. So it has definitely been a nice stock for me.
Yeah, that's really comfortable to know
Yeah,
that
exactly.
yeah. Okay, great. So Kusasai is wondering about what are your thoughts on diversification, since there's a lot of podcasts and YouTube videos which prefers to spread the risks on a max 5% per holding.
Yeah, I think we touched this a little bit, but for me personally, as you guys have heard, I don't really care that much about diversification. When I have a high conviction on a company or on a stock, I don't mind that this stock is weighing more in the portfolio than the average 5%. But in the end, it all comes back to the question of being honest with yourself. So if you know a field, this could be from your daily job. So if you're working in, let's say, pharmaceuticals, if this is your career path and you know the field very well, then I don't mind if you do a big bet on some companies that you think have a bright future ahead of them. But it all comes down to your conviction. For me, I don't mind. As I told you, I will put big money to back up my high conviction. But it all comes down to being honest with yourself. I think most people should have some kind of diversification, and I think actually most people also think of diversification in the wrong way. So many people think that diversification is, for example, owning 50 stocks. While there is some truth to it, still I don't think it covers the complete truth, because if these stocks react the same way to, for example, a macroeconomic event, or the economic cycle, the business cycle, then all of these 50 stocks will fall in terms of, in case of a recession, if you know what I mean. So you have to have diversification in terms of uncorrelated assets or a stock. So, for example, if you have a stock, a position in something that is very rate sensitive, then you have to have a position in something that is going the other direction when rates go up. For example, energy. Oil, gas has been a great play for the last year and a half, while some of the other sectors were going down. So it's not all stocks that are the same, but you need to be aware of that when you create your portfolio, when you do this portfolio allocation, to be aware of the fact that you have assets that are uncorrelated. So yeah, no matter what happens, you have a balanced portfolio. So it doesn't do you any good if you have 50 stocks, but if all these 50 stocks go down at the same time because of a recession, if you know what I mean. So you need to keep
Yeah.
diversification in mind in that sense.
Yeah, exactly. It's difficult to time these things as well, because you can't buy every stock in every sector at the same time. It's you gotta get screwed on some positions.
For
So
sure.
That's why it's important, like both Mudsen and Arne said, the higher rate of conviction you have in a company, the more weight you should have in that particular company.
You should, for sure. So actually, none of us are Warren Buffett, but we should learn from him. And he said at one point, I don't know if you have heard him say that before, but he said that diversification is a protection for ignorance. And there is some truth to that. I think there is of course, some nuances that you need to keep in mind of, but it is true. So if you know what you're doing, you don't need to have 50 stocks. If you have a very high conviction in something, I think it's okay to put a lot of money behind that conviction. Maybe you were right, maybe you're not, but I mean, if you want to create above market returns, you need to take these chances. And yeah, you can see Warren Buffett. I don't know the latest number, but he had a pretty big position in Apple in terms of weighting, in terms of the entire Berkshire Hathaway portfolio. And he's not afraid of it, because he knows what he's holding. He knows what he owns, and he knows what price it is worth and where he bought it at. And this is something that should be translated into retail investors as well, I think, but only if they're being honest with themselves and know what they're holding. So if you don't know what you're doing, yeah, sure, diversify away all that you want. But when it comes to diversification, there's also something called diversification. So you can over diversify and actually ruin your long-term returns.
Yeah, just to be a kind of a little the devil's advocate here.
Yeah.
Warren Buffett did make a huge mistake in 2014 investing in IBM, which were quite crazy, because he didn't understand the company. It was outside his circle of competence. But we will save that to another episode, because Mudsen, we will have you on board with us later on, perhaps next year as well, because our time is running out. I want to I want to ask you a question, which is from Cash Gloom now, before we end this episode, because it's kind of a perfect timing, because Fed has had their Fed funds rate meeting. They are drawing up a scenario where the growth is going to continue next year, while the inflation is stagnant, which is declining. And this gives them room for rate cuts, and they are guiding for 3 rate cuts next year. So it kind of indicates a soft landing by the Fed's narrative. And here comes the question, which Cash Gloom sent to you, was which camp are you which camp are you on? The hard landing camp or the soft landing camp? Could you please elaborate?
Yeah, so I think actually it's a very, very, very difficult question to answer at the moment, because I think we are experiencing some very experimental things in the economy, especially in the US. So when I say that, I mean, for example, you say that the Fed is projecting 3 rate cuts. The market is pricing in 5 rate cuts next year, with the first one coming in March, so in about 3 months. At the moment, it's sitting at about 47% chance of a 25 basis point cut in March already. And we're seeing a lot of inflation data coming in very soft, and the economy is slowing for sure. You saw this past weekend, China had a CPI print that was deflationary. So it was about 0.5% negative, meaning prices are declining in China. And with them being the largest exporter in the world, it kind of indicates that the global demand is falling. So the supply in China is constant, but the demand is falling, meaning prices are falling in China. So I think we can use China as a reflection on the Western world as well. The economy is slowing, and I don't think that we as a society can have 40 years of downtrend when it comes to rates. So the past 40 years, that is 4 decades of lower rates downtrend, which has now been reversed at a historical level. So the last 2 years have been rate hikes at a very aggressive speed, and a very big balance sheet expansion from the Fed in 2020, which they are now reversing. Uh, at the moment, the balance sheet of the Fed is sitting at 7.7 trillion, down from 9, and the estimates are about 6 to 7 trillion is the level that they want to get to before they pause the QT that they're doing at the moment. But all of these things have some very big questions that need to be answered, and we can't answer them at the moment. So it all depends on what's going to happen in the economy. But because of all of this, I think that it is very naive to think that inflation is going to go down and the economy is going to continue booming and nothing bad is going to happen. That is not the camp that I'm in. And it then comes back to, how do you want to define a hard landing? Is it going to be a very deep recession or a mild recession? I'm not sure about that. I think I'm more in the mild recession for the moment, but we will see a recession. That is clearly my view because of the things that we are seeing. And yeah, I think we also need to be, of course, aware of the Fed or have an interest in controlling the market narrative and the sentiment. So I think they, in the end, don't know how many times they're going to cut, because it all depends on a lot of circumstances, and some of these circumstances are beyond their control. So they are looking at some data, and the market participants are looking at the same data, and the market is pricing in 5 rate cuts next year. Yeah. So I think the Fed is trying to do their best to stay hawkish in the way they speak and communicate with the market. But in the end, they are looking at the same data. They're seeing the economy slowing as well. And we have a presidential election in the US next year, which is also going to complicate things, because we have the government in the US and the Fed kind of playing against each other at the moment. So the Fed is restricting and tightening the economy, while the government is stimulating the economy with their fiscal deficits. But I think if you want to have like a very good preview of where the Fed rate is going, I think you need to look at the 2-year rate, actually. So at the moment, the spread between the Fed funds rate and the 2-year rate is very wide. The Fed funds rate is about 5.33 at the moment, and the 2-year rate is down to 4.7 or something like that. And historically, the Fed funds rate has always been cut about 6 months after the spread widens this much. So I think there's a good possibility that we will see a rate cut in March, but it all depends on the data that comes from the economy.
Hey, great reflection there, Mudsen. I actually agree with you. I also think that during the first quarter next year, the Fed will cut, and I think it's the first time ever that both you and I have agreed upon the kind of the narrative of the rate increases or rate cuts, if I may say it like that.
Yeah, for sure. And also, I think there's another important factor that needs to be accounted for here. I've mentioned this before, not on this podcast, obviously, but on my post on Shareville, which is the U.S. debt that is maturing within the next year. A lot of it is maturing. So half of their debt is maturing, and they have a big national debt pile, and half of it is maturing within the next 18 months. So they need to refinance this debt. And personally, I think the math doesn't add up at the moment, so they're going to need the help from the Fed. I think Fed will ease financial conditions to help soften the blow of the refinancing that they're going to experience. So I think there's a lot of things that are backing the thesis of some big rate cuts coming. So you have the government debt that needs to be refinanced. You have the economy that is slowing. Yeah, I think we will see a lot of rate cuts next year for sure. And also historically, you need to keep in mind that even though we have seen a very fast rate hiking cycle, normally it's the other way around, where the decrease or the rate cuts happen a lot faster than the rate hikes. So once they start cutting, it goes a lot faster than when they started hiking. And also, of course, we need to be aware of the fact that why are they cutting? Yeah, is it because of a soft landing with everything just continue to boom and inflation coming down? Or is it because something is going to break? And if something breaks, yeah, then you have another support for the thesis of further rate cuts. They will do anything to keep a hand under the economy. So when rate cuts occur, it will happen faster than when rate hikes started. Yeah.
Indeed, you have a saying going like this: the rates always go up on an escalator, but goes down on an elevator.
Yeah, and it's true. Like in most scenarios, they cut because something happens. And you saw a very good example on this scenario here in the UK gilt market. Remember last year?
Yeah, I remember.
Yeah. So something broke in the economy, and the bond market started sending a signal to the government and the central bank, and they pivoted. And this is what's going to happen here as well. At one point, something will break, and they will do whatever they can to save the situation, which means rate cuts. So yeah, or QE.
Superb, Mudsen. Thank you so much for your time and your experience and huge returns. Really, really fantastic. Thank you so much.
Thank you guys, and congratulations on your podcast. Yeah, I saw the picture you sent me, and your podcast is gaining traction. You're getting a lot of listeners, and obviously well deserved. You're doing a great job. So congratulations on that, both of you.
Thank you so much.
Thank you.
Thank you. Great,
And
great having you on.
Thanks.
and if you want to, I'll take this part in Norwegian, Mudsen.
Ja.
Og for dere som ønsker å komme i kontakt med Mudsen, det er mye lettere å skrive til han på norsk, for dere som er litt skremt for å kommunisere på engelsk. Han finner du på Discord og på Shareville. Vi anbefaler absolutt alle lytterne å følge han på Shareville. Han skriver mange flotte refleksjoner om makro, og har ikke minst veldig fine trades som deles på Shareville, så gjerne gi han en følg. Og dere kan komme i kontakt med oss gjennom å følge linken i episodebeskrivelsen på hvor Discord-serveren står. Tusen takk, og på gjensyn. How did it go?
Mixed, I think. It went well, but I think, yeah, obviously it's my first time on a podcast, so I think some of my points didn't come across as I wanted them. But overall, I think it was good. Very cool talking to you guys.
Yeah, you did a great figure, Mudsen. Really, really, really good. Because I don't think people are aware of how hard it is to have kind of this type of discussions without looking at your partner or the hosts or the guests, people have no idea
Yeah.
how difficult it actually is.
Yeah, I agree. So a lot of the things that I said were obviously like top of mind, from memory and knowledge, which is fine. But yeah, these discussions could be obviously better when they're done face to face or through a video where you can share things and look at actual data and stuff like that. So yeah, but I think overall it went very well, and yeah, I'm happy to talk to you guys and have the opportunity.
Yeah. We really appreciate it, Mudsen. Hey,
Yeah.
we don't agree on much, but it's like you said to other members of, especially Shareville, where you said we aren't that different really as investors.
No, we're not. So
So
our focus is on the same things. I think you are just a little bit ahead on your investing journey than I am in terms of what I also touch a little bit upon in the podcast here in terms of the capital preservation. So you're more focused on protecting the downside, and I'm not quite there yet, but eventually I will transition to that phase as well. And I think when I do that, I think we will have a lot of the same stocks actually, and a lot of the same criteria that we're looking for. So yeah, we're not that different.
but regarding your background, what are your thoughts about the geopolitical issue in the Middle East? Uh, it's kind of interesting for Kenneth as well to hear, because do you think we are at the brink of a World War III, or do you think we actually are in one?
I think the chance of a World War III has never been bigger than it is at the moment, and that doesn't mean that we're at the brink of one or we will get to one. But I think there's a lot of things that are happening at the moment which are fundamental for the future. So I think we have, for the last many years, have had globalization in the world. We don't have any major wars that have happened the past many years, and this is partly because a lot of the big powers in the world have been cooperating on a lot of things, so they're getting along, and we're seeing that change at the moment. So I think we're seeing some structural changes to the world order. I think we will see more division, and you have the East on one side and the West on the other side, and I think this will only be emphasized going forward, actually. And the conflict in the Middle East is not helping this. And I think you and I talked about this when we were on the phone a week ago or so. But I think the West are actually ruining their own future here, because the way they are behaving is becoming very clear for everyone else to see, in terms of the double standards that they are doing with Israel versus Russia. It's incredible, and this is kind of undermining the credibility of the U.S. as a global superpower or as a global mediator in terms of conflicts worldwide. So normally you have the U.S. playing an active part in mediating deals, negotiations on various subjects, and I think this role is decreasing because of the world. The other countries are taking a step back from the U.S. from the partnership.
But my father, he has experienced war in Bosnia when the war in Yugoslavia happened, and he often said to me regarding wars that sometimes wars happen or occur because of economical pressure on a government which is a superpower, but on its peak. Do you think that may refer to the U.S. as well? Could I actually kind of offset the debt levels with going to war and grabbing some natural resources for themselves?
No, I don't think so. Actually, I think the world is in a different place than it was 30 years ago in terms of military superpowers. I think the world is more equal today than it was before. So the US had the upper hand before, and they still do to some extent. But I think the playing field has been leveled a little bit. So you have the opposition, who are stronger now than they have been in the past. And I don't think the US have the military capacity to take on a World War III like that. I think in general, not that the World War III will not happen because of nuclear bombs. I think it's just too dangerous and is in no one's interest. But we could see a lot of proxy wars, cold wars between the superpowers. And I think this is what we're going to see. I'm not sure we will see like direct military conflict between superpowers. I don't think we will see that.
But do
But
you
that,
believe in the narrative which Ray Dalio described in his book? I read it in 2021 that China will take over as the economical superpower within 10 years. Do you believe in that narrative?
no, I don't actually. I think China has been projected to take over for quite some time, but I think the structural changes that we're seeing at the moment are going to broaden out the power in the world, meaning not only one country or two countries will have the majority of the power. Is going to be spread out a little bit more. I think India is going to play a key role, Russia as well. Brazil, I think, also is going to play a key role. I think China has some of their own problems in terms of demographics. Yeah, so the economy is not going to be the same as it was in the past 20 years. This is my take. Also because, in terms of the deglobalization that we're seeing, many Western companies uh, are removing the manufacturing facilities that they have in China and taking them closer to home. So, for example, the U.S. is talking a lot about nearshoring, so taking some production facilities away from China and placing them close to home, which is in Mexico. I think the production facility growth that the Chinese people have been experiencing the past decades is going to change to the worse, actually.
Super,
Yeah,
Mudsen.
I don't know what you think about that, but I think this is what we're seeing, like the deglobalization, where countries are going to be more cooperating with the countries that are close to them and that are their allies. There will still be some kind of connection, but I think we're seeing a more divided world, actually. And I
Yeah,
think that
I agree with you to some extent. Uh, Before we finish off here, my thought is we the economy is so global that everybody will lose in a war. Actually,
yeah,
both.
yeah,
I really think we are at the world war just by proxy. So
yeah,
you're making a front, for instance, in Eastern Europe, in Ukraine, or in the Middle East, and then you have China, the U.S., Russia, Iran, Turkey, and India to some extent, kind of touching chin, as I like to call it.
yeah. I completely agree with you. I think it will be that kind of war that is going to play out, like a Cold War or a proxy war, and not direct military conflict, because it will be too damaging for everyone involved, for the global world. But
and
I'm pretty
and
sure that.
and it will be become too obvious for the public as well.
Yeah, I think actually there's a lot of things happening on that page as well, in terms of the public and the knowledge that people are having today that they didn't have in the past. I think people today are much more aware of what's going on and can see through them, through the things that some of the governments have been presenting for many years. So I think a global war will be more difficult to achieve this time, compared to, 10, 20, 30 years ago. But I think we'll for sure continue to see traction and tension between the superpowers. I don't think that is going anywhere. Actually, I think it's here to stay. And you saw it already when Russia and Ukraine went at it together, with the dollar weaponization from the U.S. towards Russia. You already economically, you saw there some countries moving away from the dollar and trying to create some more independence because they saw how the US could just press a button and freeze their dollar assets. So I think
and the
people are.
SWIFT system.
It's a SWIFT system, exactly. So global trade is mainly in dollars, and this means that most countries have dollar reserves, and I think these will be frozen by the US because they have shown it time and time again that if they don't like a country or if some country needs to be sanctioned, they will just freeze their assets, and nobody wants to see that to their own money. So I think most people are aware of it now because it's become so clear and obvious for everyone. And we're going forward, I think we will see more countries moving away from that. And this is also why I've said that I think the reserve currency status from the US is under pressure, not threatened, because at the moment there is not a valid competitor or replacement, but it is under pressure. And when I say that, I mean that I think we will see more other currencies take a larger share of the global share. So the share of dollars in circulation will over time decrease, I think. So we will see maybe 2 or 3 currencies unless we see some kind of structural change to the financial system, which I think also uh, is in the pipeline actually in terms of central bank digital currencies.
Yeah, I agree about that, and you see that now that sellers of natural resources actually want their own currency instead. So
They want
that's
their
the
own currency,
beginning.
yeah. And I
Yeah.
think this is what we've seen in the past. So just take Libya, for example. Gaddafi, he wanted the same thing. Saddam Hussein in Iraq, he wanted the same thing, but they both got killed. And this is not the official explanation, but I'm pretty sure it's the reason why, because they were threatening the US dollar dominance in the global trade. And yeah, of course, they don't want that in the US, so they will do anything to remove a potential threat. But I think now we're seeing more of a broader coalition between countries that are taking up this challenge. So you have the BRICS talking about it. I'm not sure this will be meaningful. I'm not sure they can pull it off, but we are seeing some countries doing stuff to move away from this dollar dependency that we have been experiencing for many years.
Yeah, that's a very interesting reflection, Mudsen, and great talking to you. So we always like to ask our guests what they would like the episode to be called, or the name of the episode. Do you have any?
Yeah, I'm not sure actually. Let me check what the other episodes are called, and I will get back to you. Yeah,
I'm very tempted to have some big bets with Mudsen or something. Like you're a real Stan Druckenmiller kind of guy. Actually, you have a small basket and you put a few eggs in it and you watch the basket real close.
Exactly. This is what I do actually. I watch my few stocks, or at least my high conviction stocks, very carefully, uh, which I think is a must when you have a high conviction that is also supported by a big bet in terms of your portfolio size. You need to be watching the stocks, the news that are coming out from the company, listen to conference calls, all of these things. I actually see it more of being an owner of the company, and this is why I like having these big bets on companies, because it makes the ownership feeling stronger. You know what I mean? I feel like I'm a real part of the company because I have such a big position in them, in, for example, Simon Property Group. So I think it's, if you're up for it, I think it's a good challenge. Yeah.
Okay, great. Okay, so I'll make an the episode name like identifying high conviction bets with Mudsen or something. I'll see what I can do.
Yeah. Perfect. Cool.
Hey, Mudsen, I wish you all the best, and I hope we will see you again, perhaps next year already.
Yeah. No problem, guys. Thank you very much. We'll
Yeah,
talk
good
soon.
night. Bye
You
bye.
too. Bye bye.
Bye.